In my experience, I see a lot of first time buyers think value in a small business takes Wall Street math, spreadsheets, forecast, 10 tabs of formulas. But what if I told you you can ballpark a company's value in under 15 minutes without a single fancy model? And you could do it with a clear certainty percentage before moving forward with a deal, meaning spending more time, marshaling resources to go get capital to buy it. Let me show you a secret formula for a rapid SMB valuation estimates. Hi, I'm Jon Stoddard from DealFlowSystem.net. I've helped buyers close 33 million in deals and raise 50 million in funding. If you're working full time and want to buy a business without wasting years on junk deals, smash that subscribe button and stay tuned. Part 1, the myth of complex valuations. All right. Most first-time buyers overcomplicate valuation. They think they need an MBA or certified financial analyst. The truth? You don't. Like, imagine looking at a 20-year-old local service company. No spreadsheet circus, no MBA math, just cash flow and strength and loyal customers. Now, picture yourself at the negotiating table. Would you stretch to pay a little bit more for this business or hold the line? That's the heart of rapid valuation. Quick, clear thinking. Spotting green lights and red flags fast before you sink months and money into due diligence. And here's the kicker too. You're not looking for 100% certainty. You're looking for enough information to move forward with confidence, let's say 70 or 80% certainty. You can always verify the rest in due diligence. Part 2, the financial pulse check. The first thing to grab is the financial report cards. That's 3 to 5 years of income statements, at least 2 years of balance sheets, and at least 2 years of cash flow statements. And the reason we ask for that is because Warren Buffett did the same thing when he was buying private companies. Now, we also ask for tax returns and bank statements too. So we're also going to ask for that if we keep moving forward. But I just want to tell you one thing on when you're looking for an income statement at the bottom line. Profit can be massaged, but cash in the bank, that's like oxygen. There's a mentor I have, Keith Cunningham, calls this profit's a theory, cash is a fact. So here's a quick story. A client showed me a $2.5 million service company with $400K in profit. Bank statements revealed overdrafts every month. They were robbing Peter to pay Paul, and we walked on that. Now, if you looked at a company's numbers, would you still make an offer? Would you pass or pursue it? So when you're looking at businesses, scan for these things in minutes. Consistent cash flow, healthy gross margins, and receivables, low AR, under control, and low customer concentration. SBA requires it. If 3 or more red flags pop up, either lower your certainty percentage or pass. All right. Part 2, the market vibe scan. Once you've got the financial pulse on the business, I kind of do a check the market vibe. Like, are they growing? Is it flat? Is it getting disrupted? I saw a buyer looking at a niche manufacturer. Numbers look solid, but the entire sector was getting crushed by imports. Our certainty percentage dropped from 80% to 40% in just a few seconds. Now, if this owner called you tomorrow with this deal, would you do it even though the certainty went down? You got to look at this and say, really quick, make a decision. Is the tide going out on this business or coming in? Up to you. All right. Step 3. Also, the future growth flicker. Now, there's another thing you can look for. Growth flickers, like tiny signals of future upside. Is it a product a need or a want? Does it have recurring revenue? Long-term contracts. Does it have low-hanging operational improvements? Can I cut expenses 10%, which could increase profitability like up to 50% if expenses are 90% of G&A? I got to tell you about one story. One student found an e-commerce brand with ugly books, but under that mess, it had 70% repeat customer rate. The two banks offered funding after we normalized cash flow, showed it actually what was going on in the business, the narrative. Now, if you were sitting on the other side trying to buy it, would you run the business the same way? Or would you flip this model entirely? Like flipping a house or working on a car and flipping it, or just keep it forever? Just curious. Put your answer down below. If all in all is great and looks great, it's bright, my certainty percentage goes up on deals like this. If it's dim, goes out, and I pass. Part 4, unlocking hidden value. Now, numbers will tell you one story. Now, and operations are going to tell you another. And one of those is looking at owner dependency. I mean, that will kill value. But reoccurring revenue on the other side could multiply it. Plus, you have intangibles like brand, IP contracts that don't show up on the balance sheet. So you've got to make that decision pretty quickly on this type of business. You have to have a story and a narrative about it. Keith Cunningham teaches scorecards and 4 to 5 key drivers. It's called the ultimate blueprint for an insanely successful business. And he calls these 5 key drivers conversion, retention, average ticket, and margin. A small improvement in each moves valuation up. You could, with that business or any business, normalize numbers, strip out one-time expenses and owner perks, and do a stress test on the cash flow. Can it handle any downturn in the business? Because we all know what downturns look like with that black swan and COVID event just a couple of years ago. Part 5, the big reveal. Here's the number 1 hack. We've talked about the financial pulse, the market vibe, and the growth flicker of a business. That's the story, what makes it tick, and why it's continually buy from the business. But here's the big reveal. The number 1 hack that separates amateurs from pros. And the question you have to ask every time. What is the real cash flow? Because that's what you're doing. You buy cash flow at a rational price. Repeat that. You buy cash flow at a rational price. And the price you can pay for a business isn't about the seller's dreams or what the broker wants. It's about how much debt the business can actually support. Again, it's about how much debt the business can actually support. And the amount of debt it can support is based on how much cash it generates. Real, bankable cash to service that debt. Because you're going to borrow from the SBA and a 90% loan, for example, the bank does not look forward. They look backwards. They're underwriters, not fortune tellers. They study the historical performance to see if your loan on this business that you're interested can be supported based upon the past. This number is what they hammer on when underwriting your deal. They're looking for the real cash flow, stripping out all the charades. It's not your pitch deck. It's not your dreams. It's not your vision board. It's just historical cash flow. Now, here's the math nobody tells you about. If you're using SBA debt to buy 80 to 90% of a business, which most first-time buyers do, the debt load determines the valuation, not the listing price, not what the broker wants or what he anchored the seller on cash at close. SBA lenders usually want a 1.5 to 2x debt service coverage ratio. That's DSCR. Private equity, as you go up, middle market, upper middle market, they like 2x. And I personally like 2x as our margin of safety also. I mean, the reason we do this is because at a 2x, only about 50% of your cash flow can go to debt payments. And that means the other half, for you, the business, for reinvestment or for surprises or just paying other bills you don't see coming up. And let me give you a warning here. At 1.5, which a lot of SBA lenders will do, debt service coverage ratio, your debt payments eat up 67% of your cash flow. That's tight. That's risky. It's one speed bump away from trouble if the business doesn't grow. Think about it this way. At a 2x debt service coverage ratio over 10 years, if you never grow the business, half of your cash flow goes to debt every year. At 1.5 debt service coverage ratio, it's 67% of your cash flow year after year after year. That's why you work backwards from cash flow. You have to find the true bankable cash. What you do is you divide that by what the lender requires for debt service coverage ratio. That's your maximum debt load. And your maximum debt load sets your valuation ceiling. Here's the deal. Your maximum debt load sets your valuation ceiling. Doesn't matter what the seller says. It doesn't matter what the broker said. Here's a little hack I teach my students to do. Go to ChatGPT, go to Gronk, whatever you use to run a quick debt scenarios. Type in this. What's the yearly debt payment on a $950K loan at 70%, 80%, and 90% loan to value, LTV? Real quick, you're going to see the payments. You'll know exactly if the cash flow can handle the debt. So let me give you a perfect example of what ChatGPT did for me. So at 70% loan to value, about $658,000 is finance. And you're looking at roughly $9,000 per month or $108,000 per year. At 80% loan to value, that's about $752K financed, and it's roughly about $124,000 a year. And at 90% loan to value, about $846K finance is roughly $139,000 per year. So if you're looking at the income statement for 2024, 2025, whatever it is, 12 months, and it says $65K, there's no way it's worth $950,000, right? You say pass real quick. See how fast that you can make that decision? When your cash flow is only so big, the debt service coverage ratio margin gets tight quickly. That's why you got to work backward from cash flow. Now, question for you. Would you still move forward if you saw 2/3 of your cash flow eaten up by debt? And if you knew, I don't know how to grow this business yet, or I do know how to grow this business yet, there's probably more certainty based upon those characteristics, right? Profit is a theory, cash is a fact. And when you're buying a business, you're not buying the story, you're buying the cash flow and its ability to safely carry that SBA 7A debt. All right, part 6. You've got to ask for the right financials to be able to do this. Back to the story of Warren Buffett, the language of business is accounting. If you don't know accounting, you can't tell the winners from the losers. That's basically it, right? There are ways to do that now to help you out. There's some tools that help you out, like dealsage.io. You can upload all the financials. It's encrypted, and that'll run some financial analysis for you. But you need to ask for 2 to 3 years of income statements because you got to have context. You got to see if they're doing good, if they're doing a good job of turning assets into cash flow, their efficiency, productivity, and effectiveness. You need 2 to 3 years of balance sheets, 12 months apart. You just got to see what they're doing with their cash. Is there cash in their bank? Is there AR increases? Is accounts payable but decreasing? You got to measure that and look at the context. And 2 to 3 years of cash flow statements, right? So also line it up with tax returns. If you ask for the tax returns, you're going to get this 1120 documents. Those are going to be a little bit more conservative because they're a different purpose. Most small business owners, when they file the tax returns, they want to minimize the tax exposure. So it's going to show a little bit less in miscellaneous deductions. But Warren Buffett always asks for these documents, these financial report cards. They reveal how the business really operates. And when you line up those income statements, the balance sheets, cash flows, and the tax returns side by side, you're going to get a dashboard view. It's like getting on the hood when you're buying this car before you take the car on the highway. You know what's happening here. You run it through some tests. You like, is it leaking oil? Is it timing's right? Is it, the pressure grade? Everything. You're going to run it through some tests. And again, back to dealsage.com. I did a webinar with these guys. They're great. You can upload all these financial documents, get a reading financial health of the business. Let me give you a kind of an example that you can work through. Let's say a live example. You got a business doing 1.2 million in revenue, 300K SDE. Write it down. Owner works 60 hours a week. There's no contracts, no long-term contracts. Based upon what you've learned from this video and the formula, like adjust for owner dependency, adjust for reoccurring revenue, adjust for market trends. Is it a need or a want? And is it going to hit by a train like AI or not? That 300K SDE might drop to 180K bankable cash flow. At a 2.5 multiple, that's, if I did the math with ChatGPT, that's in a 450, 500K offer range. My certainty percentage that I look at, I would say it's about 70% sure before I say this is a great deal, go sign an LOI. Due diligence would raise or lower these numbers. Would you do the deal? Just curious. Put in a comment down below. All right. Always ask for the bank statements. Always ask for the income statements, cash flow statements, and balance sheets, 2 to 3 years, closing at the same day as the income statements do. Always stress test cash flow. You don't have to wait for this model to be perfect to get good at reading accounting documents, financial report cards. But you do know how to read it because you're going to own the business and you're not going to know how to improve it if you don't know what to do. Start scanning those deals right now. Get all the documents, get assistance from somebody or use DealSage or whatever. You've got to learn how to read these financial report cards. And that's why the report cards. Are you doing good? You're doing bad. Here's where you should improve. All right. If you found this video useful, smash that subscribe button. And if you're serious about buying your first business, I can help. Head over to dealflowsystem.net. That's where I'm going to show you how to find, fund, and close your first deal the smart way. I'm Jon Stoddard. I'll see you on the next one.